How are you, folks? Enzo DiCostanzo, clinical professor, economics and finance in St. Peters, New Jersey City. And today is another video for the first week of October. And we're going to talk about tax liability. We're going to talk about married filing jointly. So away we go with all this stuff. All right, folks. So we're here. I think we spoke about head of household last time. And now we're going to talk about married filing jointly and what this means. And a little bit, I'm not going to spend the whole sort of time on this, but we'll talk about this a little bit. We spoke about single and head of household and that kind of stuff. So it's for married couples who've wed before the end of the tax year. When filing taxes on married filing jointly status, a married couple can record their respective incomes, deductions, credits, exemptions on the same tax return. Okay. So yeah, and I'm not trying to be horrific by saying this. I've said this in class, and it's just my opinion. I'm not saying don't get married or any of those kinds of things. But when I was at the 4 years I was at Queens College in Queens, New York, I learned really what the legal definition of a lot of things were, including marriage. Here, the guy who taught the course was married, had a happy marriage. Actually, his wife was an attorney also, and she taught at the college too. And actually, he was a Rutgers guy, so he went to Rutgers, and then he was from Queens, went to Rutgers, and then spent like 3 decades in the New York State court system. I don't know where he is now, but I think he moved on from that somehow. But I think 30 years is enough. Pensions and all. I think you're more than vested for the folks out there who think about stuff like that. I think you're more than vested with all that kind of thing. But basically, marriage is, and he said it like this. He said it's an emotional decision, or you're making an emotional decision to combine assets and liabilities and credit ratings and legal exposure, all that. When you're married, you're like one person in the eyes of the court, pretty much. So almost, not 100%, but almost. So incomes, deductions, just keep that in mind, okay? And again, you're making this decision based on emotion. You're not really making it based on too much rationality, not too much rationality. Anyhow, married filing jointly is often the best choice when one spouse has a significant income. If both spouses work and the income and itemized deductions are large and very unequal, it may be more advantageous to file separately, like we showed you in the previous video, where I went through head of household for a couple different tax brackets and sort of a couple different scenarios. There's really, let me tell you, schools and math books and business textbooks and business schools and all this other stuff. Like, say, oh, if you just take a shortcut, but it's not really. You really shouldn't work. You should go through, because there's not that many scenarios. You're not just testing, every iteration of a portfolio or something like that. And let's take all the S&P 500 stocks and weight them differently and see what that's going to do to our returns and gains and losses for the year and our tax exposure and whatever it might be. You have to go through the scenarios. Okay, so deductions, itemized deductions, income. So, again, you want to determine, of the sort of 4 choices that you have, which one is going to give you the lowest tax liability and the lowest taxes owed. If a couple uses only one tax return, both spouses are equally responsible for the return and any taxes and penalties owed. When using married filing jointly status, both spouses are equally responsible for the returns and the taxes. If either one of the spouses undertakes or understates the taxes due, both are liable for the penalties unless one spouse can prove they're unaware of the mistake. And good luck in living something like that down, living under the same roof as that other person, doing something like that. Taxing get technical and tricky. So if a couple's having trouble determining tax liability, they should talk to an experienced. Of course, okay, that's always true. And then you make the comparisons. But yeah, I mean, folks, look at this. I mean, we can here. We'll just bounce out of this for a second. Now, these are not all IRS documents, but they're mostly IRS documents. So I'm right-clicking on the folder where I keep all the documents for this set of lectures, And again, I guess as soon as the hard drive or the cache or the random access memory catches up, I have 49 files in there. So let's say 45. Okay, let's say, because there's a couple spreadsheets in here and a couple other things, but not much other stuff though. The student CPA stuff is here. So let's subtract out 5 or so. Actually, all of these here, we could even do it like this. It's like 44. I bet you it's gonna be 44, including Sarbanes-Oxley. I just highlighted all these files, and we'll just do properties. It's like 44, 39. Okay, fine, 39. Okay, but that's so 40. There's about 40 files, and plus or minus a couple Sarbanes-Oxleys and whatever it might be. But enough. All the different publications. So going through, and these are all 20, 30, 40 pages. Some of them are about 100 pages. Okay, so again, the next time I do this, we'll have a better version. Like so many things that I do, there's always a better version later. But as we're doing it now, we sort of are where we are with this. The Internal Revenue Services encourages couples to file together by offering them various tax benefits that don't apply to other filing statuses. There's a bigger deduction, standard deduction, and there might be some, a whole list of other benefits, maybe some tax credits. So, including the earned income credit, the child independent care. Again, you shouldn't have kids just for the tax benefit. Okay, having children, having a family, and especially in the unglued environment. I'm quoting Warren Buffett. In the unglued environment that we live in today is quite a challenge, and there's no other way to say that. So married couples filing jointly generally have access to more tax benefits. And again, these are some generalities here. The joint return will often provide a bigger tax refund, a lower tax liability. Not always the case, but the couples, you want to investigate your options by calculating the refund of the balance due when filing jointly and separately, then using the one that provides the biggest refund and the lowest tax liability. That's basically what you're after. If you guys don't mind, I'm just gonna check us off the list here. Here's some of the requirements, and again, it's really what this is doing for you. It's giving you experience reading almost a legal document, or almost reading case law. Just a very detailed, a very technical document. If this happens, but very logical. If this happens, if that happens, whatever the situation might be. If you're married, 364 days instead of 365, what's the situation? How do you jointly file that? You got divorced on December 30th, and what have you. So again, so if you're married on the last day of the tax year, so yeah, it says, in other words, if you're married on the 31st, you're considered to have been married all year. If you're unmarried, divorced, legally separated according to state law on the 31st, and you're considered unmarried for the year. There's an exception to this rule for the death of a spouse. You and your spouse both agree to file joint returns. Okay, and again, you should always do the computations. It says if you were not divorced or legally separated on the 31st, you're considered unmarried if all the following apply. You live apart from this. Yeah, so now it gets right. It says, again, think about this. It says if you are not divorced or legally separated, but all of the following apply. You live apart for 6 months of the year. Yeah, okay, you're considered unmarried. All right, that's right. You're considered unmarried if all of the following apply. You live apart for the last 6 months of the tax year, not including temporary absences for reasons such as business, medical care, school, military service. You file your tax return separately from your spouse. You paid over half the cost of keeping up the home during the tax year. Your home was the main home of the children, stepchildren, or foster children for more than half the tax year. All those have to apply. Okay, and then there's a couple questions here. Is there a benefit to filing taxes as a married couple? Right, all that stuff. It says, is there a benefit to filing taxes as married filing jointly? When should married couples file taxes separately? What is the standard deduction for married filing jointly? We looked up this 25,100. We looked up all that stuff previously. All right, we took a look at that stuff. Okay. Yeah, so we looked those up in the PDFs. Okay, and like I said, we can review those. Those are just reviews of the topics that we just looked at. Tax liability is because what I want to do is I want to work out the 2022 version of what we worked on last time. We did this for 2021. All right, we did these two. It says head of household versus single or married filing separately, right? And we did the 2021 tax brackets for 70,000 person earnings and what the standard deduction was and things of that nature. And that's going to change to the next year. So you had the single year and then you had the head of household year. Okay, so you had all of that. Okay, but so I want to go back to whoops, there it is. Okay. A tax liability is a payment owned by an individual, a business, or other entity, federal, state, or local to federal, state, or local tax authority. In general, tax liability is incurred when income is earned and when income is generated by the sale of an investment or other assets. A local or state sales tax might be incurred when goods are purchased. The U.S. does not levy national tax sales taxes, although some countries do. Okay, so again, any balance sheet terms you want to run to and really understand it, right? So it's possible for people to have no income tax liability if the taxes owed was zero, or if the income was below the level that was required for them to file tax returns. Okay. A tax liability is the total amount of tax debt owed by an individual corporation or other entity to taxing authorities such as the Internal Revenue Service, income taxes, sales taxes, capital gains taxes, all forms of tax liabilities. Taxes are imposed by a variety of taxing authorities, including federal, state, and local governments, which use the funds to pay for services such as repairing roads and defending the country and buying aircraft carriers, of which we have the most of in this country. Both individual and business can lower their tax liabilities by claiming deductions and exemptions and tax credits. Okay. So, and if you guys give me a second, I just want to create the, the, the labels for the, just give me a second. These are just sort of the summaries as to what we discussed. There we go. And we'll take care of the rest of this. So we're here with this. Okay. So we have all that, and we'll worry about that another time. Okay. So yeah, I just wanted to set up what we're going to put online there. So yeah. So here, taxes are imposed by a variety of authorities. We already talked about this: federal, state, and local. Right. We looked those up here. Use of funds to pay for services and all the uses of taxes, of tax revenue. When taxable events occur, needs to know the tax base for the event and the rate of tax on the tax base. So yeah, we did cost basis recently. I made the notes. We're not going to present that today, but I made the notes for that, so we can look at that at some point. Sales taxes, company payrolls, or forms of tax liabilities. When businesses sell their products, many states and some local governments charge sales tax, which is a percentage of each sale and is paid by customers. Businesses send the sales taxes. They collect to taxing authorities monthly or quarterly. Companies withhold income taxes and taxes for Social Security and Medicare from. So yeah. So and again, I somewhere I did I did the whole Social Security Medicare computation. So you have state sales tax, you have property tax, you have Social Security tax, you have Medicare tax, you have all that type of stuff. An individual or corporate tax liability doesn't just include current year. It factors in any and all years from which taxes are owed. That means if there's a back taxes, any taxes that remain unpaid from previous years, those are added to the liability. That's something to keep in mind. So the entry, the balance sheet, it could be from other years. Okay, that's something to keep in mind. Okay. Most common types of tax liabilities for Americans are taxes on earned income. So if Ann earns 60,000 gross income, which is reported in the IRS W-2 form at the end of the year, with a federal tax rate of 22% for that level of income, Ann's liability would be yeah. So this one, it's 8,949 based on 2020 tax brackets. And would owe 10% for the first 9,950 of income, 12% on the next 30,000. So yes, actually, if you look at this, this is what I'm not going to do the 2020 version of this, but this is what people I was getting emails based on this today. Okay, this was 60,000 and yeah, we did 2021. Yeah, we just I just did 2021 with this. Yeah. Okay, so yeah, this we're gonna hit this version, but here, just to keep this in mind, you break apart your 60,000 into the brackets. You've got to type the brackets in. Okay, that's what I think that's where we had a little confusion with that. See, these are the brackets. This is the 2021, 2021, and we're gonna hit today, we're gonna hit 2022. That example was 2020, but we don't care about that. So yeah. Okay, so you've got to type these in, okay? And I'll review where these come from again. I'll sort of repeat myself here where these things come from, okay? But you've got to be able to hit those, okay? Or at least this is all typed in. That's typed in. This is computed. You just subtract the endpoints, right? See here, you just subtract those, right? This is the next set of endpoints. I'm going vertical this time. And then this other one, where it's 80, I think it's whatever, 70,000. So this is so you're in here, you're most of the way, you're about 75% into this bracket, but not all the way to 86. So you take 70,000 minus the endpoint, and that gives you 16, right? Or whatever it is. Yeah, so this is yeah, so, right. That's 70 minus oh, pardon me, taxable income, whatever, 57,000. Pardon me, 57,000, right? Because there was you took out the standard deduction. Okay, but so these are typed, these are computed, and these are typed, and then the taxes. Oh, this is the amount subject to tax, and these are the taxes owed. Okay, that's what I was getting a question. I was getting a number of emails from people today, but that's what's going on. And same thing here. This is we just typed out. Okay, this is 2020. We're gonna do 2021. So, and this says that the W-4 resulted in a um, yeah, W-2 and W-4. What are those? W-2. Let's see. The IRS has nice definitions of this stuff. There's Investopedia. We always like Investopedia. Form W-4. Right. You fill out the W-4. Correct. You're filling out the W-4 form. Yeah. W-4 is what you fill it out. W-2 is communicated to the IRS. Okay. That's the differences between those. Okay. So just keep that in mind. Tax year. But yeah, this is something I need to go through what the W-2 is, what the W-4 is. We're not going to obviously deal with that today, but I should go over that. Or again, we're always getting ideas as to what to do with the courses, right? As we're sort of teaching them. So tax statement, how it's read. That. So again, at some point, we'll maybe go over some of this stuff. Okay. 24. Okay, so yeah, we'll get to the distinctions between those. But like I said, this is something we're going to care about now. And this other thing, the federal tax rate, that's the marginal rate, which means how far up the rate you go, and then you have an effective rate, which we already sort of dealt with computing that. So yeah, the W-4 is her employers shows withholding and federal taxes. She made $1,000 payment during the year. When she files a 1040, her individual tax return, the remaining tax payments due, which is 8,949, less the 65 in withholdings and less the payments. So, but again, yeah, this is going to be actually this we're going to discuss. This is the next sort of example. I'm not going to work on this today, but when we go through the IRS lecture, we're going to go back and okay, we'll do a tax liability. We'll do it based on 2021 or something like that. Residents and business owners in Louisiana, parts of Mississippi, New York, New Jersey were granted extensions because due to the hurricane, the tornado, whatever it might be. The Kentuckians were also granted some extensions. The Commonwealth of Kentucky, you can consult the right disaster relief announcements and things that it's never good to delay things, but okay. How are capital gains taxed, and also we have a pretty extensive, and we'll briefly talk about it here. But we have a pretty extensive discussion on that, and we'll get to that. So when taxpayer sells an investment, real estate, or any asset for gain, the individual owns taxes on that gain, and that's something that we're going to get to. One second, folks. One second. Just for reference right now with the W-2 and the W-4. We'll cut through these eventually. It says, yeah, this is when you get a job, when the piece of paper the employer will ask you to, so you complete the W-4. All right, the withholding certificate. So the way you fill the form out determines how much tax it withholds from your paycheck. Sends money, it withholds from your paycheck to the IRS along with your name, social security number for reference. Your withholding counts towards your annual income tax bill that you calculate when you file your tax returns. Okay, so the W-4 you fill it out. When you start the job, you do that. It's the withholding certificate is really what this is. Okay, and the W-2 is the wage and tax statement. Okay, and this is sent to this is what's sent to the IRS. The W-2 is sent to the W-4 is what you fill out. Okay, so just keep that in mind. We need this for something else. And actually, I want to brief this case if we can get to it, but we'll see what happens. Okay, but yeah. So again, so this is really what I care about. How we break this up. That's the most important thing. So 10% on that first piece of income, and then 12% on this piece of income, and then 22% on the last piece of income. The W-4 resulted in the employer withholding 65. Okay, went through all that. Fine. And some of the different states and how the capital gains are looked at. So someone purchases 100 shares for 10,000. Then it's worth 18,000. There's an $8,000 long-term gain is considered the tax base for this taxable event. And so it's a long-term capital gain since the stock was held for more than a year. The tax rate for capital gains can be different. Rates can be different from the rates for income taxes and other tax calculations. If the rate is 10%, the tax liability is 800, and includes this calculation on the 1040. Okay. Line 16, which appears on page Form 1040, is your total tax liability to the IRS. So that sum might initially make your stomach turn because it can appear high. However, when your tax liability is calculated, you adjust for federal income tax withheld, deductions, exemptions, tax credits to compute amount of the tax currently due and unpaid. If you overpaid, you can get a refund. If you pay too little, you'll owe the IRS something else. And we're going to go into what the IRS is. But like I said, so for this other example here, we're not skipping this. We're just pushing it to another video. Okay. Okay. So we hit these two pieces that I wanted to hit. Actually, I just want to make a note here. If you guys just bear with me here. This is we're going to do tax liability example, and we can do the gross income. So this was in the video, and then we did married joint file. That was in the video. Okay. So yeah, it's going to stagger things a bit too. I like a little bit of a staggered approach to things. All right. Yeah, so let's return to our example here. Forget about this, whatever that is. I think that was Knobworth a number of decades ago. Let's forget about that for the time being. So yeah. So yeah, here was the problem last time. We were comparing head of household versus single or married filing separately, not married filing jointly. Okay, you had 70,000 taxable income. Okay, and then again, you had a standard deduction with this. So had we look at this, this was had a household, and this deduction was 18,880, right? And then we did single or married separately. This standard deduction was 12,550. Okay, and we compared amount subject to tax, right? Both of those which was a little bit more under the single version, and then in terms of the tax bill was certainly more under single. Okay, 8,000 versus whatever 5,860. Okay, and I think then we computed the delta, right? The delta of those two, the taxes owed under the two different filing statuses was about 2,527. That was last video. Now we're going to do the 2022 version of this, and we need the tax. So here, this was exactly a question that I had in class today, and we're going to basically answer that question right now. So you see, we have the tax liability one. This will be the next video. We'll pull that together for the next video. Okay. That'll be the IRS and maybe gross income or something like that. Oh, so this is the version, and what I'll do is I'll take this yellow away, but just because all of these sort of levels seem so similar to each other. Just to remind us that we're in 2022 at this point, right? So just to remind us what we're doing here. Okay. So now we have to build the brackets. So let's look for head of household and single married filing separately. Yeah, so see, we don't have that on video for any of that. Married filing jointly we don't need, but yeah, so let's do the both of these and pick out the standard deductions. There was an instruction sheet that we had. We'll see here. We have the 2022 standard deductions here. We'll check those. 19,400 and 12,950. We'll get to that. Okay, we'll get to that. But here, let's go to the single version of this for 2022. I think I had this somewhere here. I know we have 2022 tax form instructions. I know we have that. That's Sarbanes-Oxley was there. I think we have the estimated tax document has 2022 in it. Yeah, here it is. So 505 has those brackets. So IRS publication. This is tax withholding and estimated taxes which isn't over yet, by the way. So this in and of itself is 45 pages. Usually these are at the end. The tables are generally at the end. Yeah, here it is. These are the schedules. Okay. So this is what the guy was asking me this on email today. But this is for 2022. You have for 2021. I think you have the 1040 IRS instructions or whatever. But you want to seek out something like this, right? So these are the singles. which are here. So what are we going to do? We're going to sort of scrunch that into the corner there. That there, yeah, actually, the two we need are right there. Married filing separately and jointly. Yeah, these are almost the same. Yeah, they're not. They're not exactly the same. You got to keep that in mind. All right. This is single. Married filing jointly. Had a household. And if you need sort of, if you need that other one, the married filing jointly or whatever, single married but filing single filer, you got to go get it, right? There's no two ways about that. So, what is this? I don't know what this is. Okay, so you're here with this. Oh, this is single 20. I have these worked out somewhere. We're still at the same percentages, which are fine. So now this has been expanded. This was 0, 10,000, right? 275. Remember, this is like when we first got together, right? 10,000, 276, 1,000. So you're just going through, right? 41,000, 776, 89,000, 075. 170, 50, that one, 170,051, 215, 50, 215, 951, 539, 900. This is over 539, 900. Okay, so we're a little bit more across the board with this, right? Well, across the board a little bit more. Still, the percentages are the same. Let's find the standard deduction. Let's do that. But while we're here, let's do everything that we have. We'll go back for standard deductions in a second for 2022. Okay, this is single filing status. Fine. Married, we'll get to that another time. This is, we care about head of household. This is married filing jointly. Right, here's head of household. So you want these brackets. Okay, so again, these are, you're typing the stuff in, right? And they're similar, but not exactly as the previous. There's 14,650. Oops, this is 14,650. 14,651. 1. 89,000. 89,051. 170. 1,000. 593. 539,900, 539,901. Whoops, this is over. Yeah, this is over. Okay. There. Okay. That's your head of house. Again, the same. Check your percentages. Make sure they're all matching up. Okay. Now, the filing separately one, it might seem the same, but it does change a little bit. Some of them are the same, but some of them aren't. So this is for, those are the same, those are the same. So the first 3 brackets are the same, the first 4 are the same. The 215 is the same, and then it changes at the 35% spot. It changed. The last 2 are different. Okay, so just keep them. But again, these you type. Okay, there's no computation here. These you're typing these in. Okay. Okay. So we did a single taxpayer. This was head of household, and now we need to dig up. We need to dig up the standard standard deductions. I say standard deviation, standard deductions. So let's find the standard deductions to the stuff. And that's going to be here. It's going to be in this document. Next. There we go. Okay. So we have them here. Yeah, and some of the confusing part with this. So this is whatever page 2 or something. The confusing part is see where it says single. It says single married filing separately. So this is 12,009. And again, we spoke about this in class. Whoops, that shouldn't be too different, right? This is for single. This is for head of household, 19,400. Okay, save all this as you go. Okay, so now you have your deductions, and I think somewhere over here, yeah, we typed them in too. So this is head of household, standard deduction. This is 19,400. And this is single or married separately. This is 12,950. Okay. All right. So you type those in. And also now you don't have to go back and recompute all those tax rates, right? So you dug into head of household, you dug into those rates for 2022. Let's just grab them, right? You're just going to copy them. You're just going to do it come like this. This is the copy. This is head of household, and you'll arrow over. And some of you are really trying it, which is good. And you should. Okay, you should really try to work all this stuff out. I escape. Okay. Yeah. All right. Let's head a household. This is single, married, filing separately. Yeah. Now for this thing, I'm gonna take these from here, but we know that in here this changes, so it's not the same as single. Single and married filing are not the same here, but we know that, and if we get down to that level, we'll worry about it. But I don't think because this is only for like a $70,000 income or something like that. So we're not going to. But down here, these these need to be. I'm just going to put a little light. We need to determine what we're doing here. These are not the same when you get down here. We just saw that, but let's not worry about that right now. Okay, because this number is what are we talking about here? So the earnings are 70,000. Okay, the earnings are 70 across the board. These earnings are 70,000. So for the tax year, when you're making 70,000, that's you're in the same ballpark under single or single married filing married and filing separately. So and it says it in sort of text up here, but we're going to do the 2022 version of this. Okay, and earnings are going to be 70,000. Both, right? Just copy. Those are both 70,000. Okay. We have our standard deductions that we know what they are. So we're here equals negative 19,400. Yeah, so for this one, it's not even gonna, and let me tell you, and if you want to just instead of retyping in the formula under taxable income, you can just because taxable income is you're just adding, you could just copy because nothing's anchored and just drop it off. And you can do the same thing for the other version of this. You can just drop off taxable income there. Okay. And this minus 19 is here. That's this. It refers to this minus 12,950. Right. That just comes from there. And actually here, right. You guys remember this, the audit arrows, right? Where this number comes from. So it comes. Now these arrows vanish, TUA. But again, my keyboard is set up for the shortcuts, and I know all the keyboards are not, which is a shame. And I'm just clearing out some of the the filling here. Okay, but this is the so again, so these are looked up. Okay, that's the question. These things are looked up. Okay, tax rates. Um, I don't think the tax rates change. Yeah, I don't think the tax rates changed, right? I don't think so. And here, alt. With the borders. Okay. That's those same percentages. And down here, bang, same percentages. Okay. So yeah, you're looking at that. Okay, but the tax relief number, where did this thing? Oh yeah, the tax relief is you take your effective rate and you multiply by the deduction. We're gonna get to that. Okay, so now we're doing this. We're doing the same computation now for 2022, and now you start to see, whatever this is, taxable income 50,600, taxable income 57. So the text sort of in there, and I mentioned if you could use the concatenation function, which puts a lot of strings together. Where I'm doing this in class. We're just doing this a couple times. But if you were repeating yourself with this a lot, you would want to concatenate some of these lines here. So you want to link this to this, and you want to link this one to the tax bill, and you want to link this thing to the taxable income. So those, and actually I may even go back and just sort of work on that, because I think that's we'll see how we're going to deal with all that stuff. But that's important. And actually I'm looking, let's see, for probability. I probably have that stuff somewhere around here, right? Yeah. This isn't percentage, but what you have to do? You have to look up like percentage and the different sort of texting. Um, yeah, you have to go to the help menu. Uh, yeah, let's see. Whatever, that's fine. It used to pop up. Here it is, Microsoft support, and it went through how to get a percentage and how to turn it into dollars and things of that nature. So yeah, here it is. This is what they're. Oh, it's retired, but it's not. This is the text function, okay, in Excel. Okay, you have dates, percentages, the different number versions of things. Okay, how to put the strings in, all that, and we'll see. We'll see towards the end of this thing if we have maybe a little bit of time, we can maybe work that out. Yeah, you just put some commas in there. That's it. So we'll see. We'll see how quickly we can maybe make that happen. Anyhow, so yeah, so looking at this, so and maybe we'll just do one of them, and then you can start changing. We can go back to the 2021 one and start changing stuff. Anyway, I want to get back to sort of the concepts here that we're dealing with. So we're here with this. All right. So what happened? So single, fine. All right, we're there, and this is head of household. Okay. Yeah, so you have the brackets, you have the standard deduction, so you got to your taxable income. Now you got to look through, and again, for the second one, single marriage separately, they're going to be different. The last two, but the first five are okay, are not going to be different. So what you can do, so if you got 50,000, certainly 14 covers part of that. So you're going to say equals. Well, not even that. This is amount subject to tax is that minus, right? And the next one is going to be, if you're in the 50s, now with this one, you're going to say equals, you're going to cut it with the 50,600 minus your previous bracket, and that's it. That's as far as you got to go with that. Right. So, and you said, well, Professor, how do you know what you're doing is correct? You want these to equal your taxable income. And it does, right? Those match. Okay, see how that matches? This down here matches your taxable income up there. Okay. Oh, so that was okay. You have the rates that are here. And then this is just equal product of that array. All right. So you're going to tax. So this is 10% of 14,650, and you're going to copy this. All right, this is 12% of 35,950. That's 4,314. Okay. Here, this is the effective rate. We're going to get to that, and this is just the summation of what you're paying in taxes. This is your taxable income. This is what you're paying in taxes. That 5,779. Okay, which is what that is, and then the effective rate is simply what your tax bill is divided by the taxable income. Okay, is that, and the marginal rate is right there. That's marginal. Is how far down you go is the marginal rate. So here we just as we're sitting here talking, um, equals. Let's see, where is it? How do we spell it? It's concatenate. And what you could do is you could just click on the function, okay, which is what you can do. And then you can type in quotes, and see, here's the thing. I want this to italics. So I might not rate is comma. We'll click on that 1114, another comma. This figure. And actually, even with this, putting in this figure nonsense. See, so what this does is this sort of helps you like that. F2, this, whoops, I don't want that. Home, this figure is arrived at. That's like that, right? This we don't need. And you can see though, fine, effective tax rate, good. But it doesn't format that number. You got to format that number, and you got to use the Excel, the text, the text function here. And there's got to be a way to make that italics too somehow, bold or something like that. Scientific notation. Is there an italics function? Yeah, it's this stuff. Uh, yeah, we're almost getting into macros a bit by doing all this, but okay. Or I don't know, maybe you can just hit italics in there too. That might be able to work. I don't wanna spend forever trying to dig this up, but, yeah, we'll have to get to that at some point. But regardless of that, you can see what I'm talking about here, though. So now this thing relies on that number. Okay, so and also what we're gonna have to do is we're gonna have to format this. So we might lose we might lose the italics here, unless can I just make this italics? Yeah, it's not gonna do that. Okay, so all right, so let's get the appropriate format, the one we know how to do. We'll get to some of the other stuff later. So this is we want percentage. That's this thing, right? So you're gonna do text, right? You're just gonna type in text. Where are we? We're here. And what I'll do, I'll just drag this over a bit so we can look at everything at the same time. Yeah, right there. Okay, so we're here with this, and this is going to be percentage. So it's going to be text parenthesis number comma quotes 0.0 percentage quote like that. Needed another yeah, needed another parenthesis. There you go. Yeah, see the effect. So see how this is now you're not getting the italics, but this is connected to this. Okay, so we're gonna say copy paste. We're gonna delete that, and this has just got to come up a little bit. There you go. Okay, so that's how you do it for that. And then we can say copy the effective rate. This is right. Okay. This we don't have that number yet, but see, it refers to that, and we're going to get to that in a second, though. Okay, but that's how you do it. Okay, like I said, but you can see the time we spent messing with this, right? As opposed to just hitting the italics button or something like that. But that's how you do concatenate, and you could do that for all. You could do for income. You could do the figures arrived at. So, and actually, these other two are a little easier because uh, these don't have the what do you call it? These don't have the italics in it. And actually, what I probably should do, if you guys don't mind, this we don't need for the time being. We're here. This figure is. Let's make these bigger. And actually, looking at this, what we probably should do, this 8,000 or whatever it is, we should do the same thing, and which says this figure is. So we could just take both of these instead of having to constantly retype this. Um, and we can do it up here. Equals again. Once you see it, just click on concatenate right there. Okay, and we're gonna do this thing first. This figure is space quote that we have, and then you want that total tax bill. Um, this is dollars, so it's this thing, and there's no zeros, so you can do the comma, zero, and that's it. Yeah. So this is here, quote text. Gotta be in there. So there's your number, comma, quote, $, number, comma, 120, quote, return. Yeah, that's that thing. And also, I want a parenthesis. And here, we're going to say comma, quote, parenthesis, quote. Right? There you go. Yeah. Okay. That's how you do it. All right. So now these two, margin rate, let's not worry about it. This thing we can get to that. Okay, but so where it says the effective rate, whatever, and we'll get to that. Okay. We could do this last one in a second, but that's how you do concatenate. See up here, concatenate, parenthesis, quotes. You type in your text, comma, a text function, reference the cell, comma, set up the formatting, and like I said, so and all you have to do is just you have to simply go to this. You just go to whatever this is. This is the Excel Microsoft Support text function. Now, can I format in here current time, percentages, scientific notation, special number? Oh, yeah. Okay. And okay. One of these days I got to dig into this a little bit more to get the italics in there. But you just it's just the text function and the concatenation function is all that really is. Okay. And so we did all so we did all these. So those are all there's one, two, and this now again it's going to run, you're not going to really notice it, but it's going to run slightly slower because now you're putting more programming in there, kind of a thing. You're doing more of that. This is this concatenate, fine. All right. Effective, those we're going to get to. And and since we're doing this, we might as well just finish, right? And it says this, we don't know what this is yet. Oh, I hope that's not wrong. So 50,600. Okay, we'll do that one. And then we'll do let's just sort of go back to where we started with these things since we know these are right. I want to do this one equals concatenation. And we'll put just to hold it in there. Okay. And then by income, parenthesis, comma, and another comma, and a one, and this is think we got it right by income. And yeah, we got to fix the formatting here, right? We got to go back to the other thing for a second. Whoops, this we don't want. So yeah, this turned into a little more of an Excel exercise today. And what are you going to do? But that's how it goes sometimes. All right, we're here with this. We're there. Okay, this is dollars. So it's this dollars thing again. Text. Oh, this is the number. So we're in there. So this is quotes, dollar sign, number, comma, number, 0. Yeah, that's it. That's all we needed with this thing. Period. Okay. And now that you have this, just go to buy income the 3 times. Buy income and buy income. Okay. And even though you don't unfortunately have the benefit of having, working seeing the answers as we're going along. But yeah. Okay. See, but now these are all programmed. So yeah, so we did a little. So this was a little bit of a free Excel version. Like I said, it bothers me. I want to put this in italics, and I got to find the function to do that. Okay. I'm sure it's doable. So okay, save your work as you go. And we're not done with this. So yeah, the amounts of so this is the same kind of maneuver. So this is again, if we're talking about here we have a bigger the standard deduction. Here we have a smaller one. Okay, so the 57. So yeah, with this one, you have to go to a third bracket with this one. So, but the first thing though is pretty much the same, right? That's the first bracket. So here, we're here, copy, paste, right? That's the first tax bracket. You're subtracting that. I just brought that down again because we needed it. Okay. And this is your third tax bracket, which should equal 57 minus the 41. That gives you the 15. And then this is just equal to some parentheses. That's 57,049. And I can see now that popped up here, right? That came from there. This is the effective rate. This is just the same computation. I just copy and paste it, even though we don't have anything yet. And these are just all products, right? This is product, sort of the horizontal array. And get rid of the dollar signs. Make it accounting. Oops. With no dollar sign. Okay. Right there. This is the 57. That's the 8,168. That's the 14.3. Okay. This is simply this, right? It's your tax bill divided by the amount subject to tax. That's all that rate is. So these are added. These you entered. These are the deltas of the brackets until you get to the number you're looking for. Once you get to the bracket with the number that you have in there, that's what you subtract the lower bracket bound from. So if this is 57,000, it'll be 57,000 minus 41,776, not 89,000. You don't use the whole bracket. You just go into the bracket as far as you have to go. Because see, this 89 is bigger than, so you're not going to go past. That's the barrier, right? That's the upper bound on this. Okay, this is that 22. And this is just a box around that. That's the marginal rate, or the marginal tax rate. And we can do the same thing here. We could, set this to equal this symbol. Let's not. We did 3 of them today already, right? So I'm not worried about that. And actually, where it says effective, so all 3 of these now copy. this is my is this right? 11.4, 51. Yeah. This is my my master file. I'm just checking my master file, make sure okay. 57, 8 3. Okay, good. 11.4, 50, good. And this thing is good. Yeah, that's what it's supposed to look like. Okay, so yeah, we did a little extra today. We did a little Excel programming, and we're going to go back and figure out. And we're not finished with this. We have to do a final analysis of this. But yeah, so you saw once again how to compute taxes. This time a little, getting the taxes owed, but a little more complicated. Now you're including standard deduction. Before you just had taxable income and that's it. Now you have. I'm showing you how to go to earnings, to standard deduction. Okay, now with the tax relief, all this really is you're going to take your effective rate times your standard deduction. So the standard deduction gave you another 2,000. There's what it did. Here it gave you another 2,000. Okay, and these are similar, right? You took your standard deduction times your effective tax rate. That's all. That's all you did there. Always save your work as you go. Whoops, bring this in. I could just say hit Control S, but okay. All right. But yeah, and also with this, we want to do a similar, I guess, a similar computation from before. This was for 2021, and again, I'm not going to go bananas going through like we just did, and we'll be here till midnight. Concatenating all these lines, but I'm showing you that you can do it. This is for a head of household. What it saved, one tax number versus another. For the 2022 tax year, we did the standard deduction for head of household rises. Okay. 19.4 and 12,950. Yeah. 19.4. Okay, fine. They referenced the standard deductions here, but we should have something like this. So let's look at the ones we just did for 2022. So we're paying 5,000 compared to this one, 8. So with this one, single or married gives you a bigger one. Yeah. So again, head of household is a little bit less, right? And we should put that sort of conclusion line, this line of a conclusion right here. I don't know why I didn't do it before, but we're gonna do it now. So slide down here. This is for 2022 for tax year 2022. So this was equal to this minus, again, about 2,000, right? 2,388, 2,527. Okay. So that's the differences there. So okay, but there you go. So again, so obviously you got a bigger taxes owed for single or married filing separately. And again, you didn't cross over into this other range here that we would have to change later anyway. Okay, so let's not worry about, because we didn't hit it, so let's not worry about that right now. Okay. And again, save your work as you go. I know, hey, folks, these videos are long. I mean, why do you think you get paid a lot to do this? Because it's complicated. Not a lot of people want to do it. Okay, that's why. So again, so we showed you some. Whoops. Yeah, this thing is wondering if we're still there. Stay in the call. Yep. It keeps wanting to shut us down somehow. I don't know why, but that I got to keep the speaker up. That little beep that shows up there. So, but there you go. Okay, that's how you do. This figuring out federal taxes, including standard deductions and varying a computation for head of household, varying a computation for married but filing separately, and how the taxes owed change by making filing under different statuses. That's really what the whole point of this was. And like I said, we have this other thing waiting here, the tax liability example, which is it's another version of this. We're going to talk about gross income. That's another thing that we're going to look at. Um, yeah, this is example of a deduction. Okay. So we have tax liability coming, gross income coming. Okay, I don't know where these numbers come from. That looks just like an example. Yeah, so there's a little bit more coming, but let's not worry about that for the time. Let's just concentrate on what we worked on here. But there's certainly more of this kind of computation coming, and we'll hit that next time. Okay. Okay. Okay, folks. Again, thank you for your patience in viewing these lectures. We know it's a lot of work to do, but like I said, I'm trying instead of just pouring over a textbook and getting confused, you're getting a little coaching with this as we go along. So hopefully that's going to help you out, folks. Thank you so much.